Hello, everyone. Thanks for tuning back into my channel. Tom Hernandez here from the Keller Williams Studio City office. Today's video is an interview that I did with my good friend, longtime loan officer, Mike Weisberg from Lend to America. We talk about financing for investment properties today. So if you are looking to think about maybe pulling out some equity out of your home, or been thinking about going from either a cash out refi or to a HELOC, these are the two specific topics that we cover today. Hey, listen, if you like what you're hearing right now, please hit the subscribe button down below so that you can be notified of future episodes. We're with my good friend, Mike Weisberg from Lend to America. Welcome back, Mike.
Thanks for having me, Tom. Good to see you.
Yeah, Mike, just share a little bit about yourself, how long you've been in the business, stuff like that, real quick.
Absolutely. Been mortgage banking for 30 years, all types of programs, products, from conventional FHA, VA, first-time buyers. If we can't do it, it just can't get done.
I love it. That's awesome, Mike. Thanks for sharing that. Hey, Mike, today's video, I wanted to sit and chat with you about a topic that one of my clients kind of reached out to me. And I thought, man, this would be a great video because I'm sure if he's asking this question, a lot of other people are probably asking it too. And it's about investing. And is it a good time to buy a rental property and taking some of their equity out of their home to buy this investment property? So I know one of his big questions was, Tom, should I pull an equity line of credit like a HELOC, or is it better to cash out? So I thought maybe you and I might be able to kind of spend some time and maybe kind of go over the differences about them, right?
Absolutely. So the biggest thing is, both of them are taking cash out. So one's a first mortgage, one's a second mortgage. So a cash out refinance, you're redoing your first mortgage, taking additional money, paying off your first loan, and taking cash back. An equity line is truly a second mortgage. Goes behind your first mortgage and has a lot of varying terms, which we'll get into in a minute. Is it a good idea, and how does it work? What we look at right now is home values being the highest in history,
right,
that we've seen. So if you're going to tap into equity, now is the most ideal time. Rates are still historically low,
right,
and your home value is the highest it's ever been.
So if we were to look at okay, Tom's house, I owe, let's say $400,000 on my house. It's probably worth 900 grand. Hey, Mike, I'm thinking about wanting to pull some of this equity out right now because you're saying it's a great time. And I want to buy a rental property. So
typical investment properties that you're going to buy, you're going to need at least 20% down.
Okay. So if I was looking at a house then that I wanted to buy rental-wise, 800 is probably the fair going price for our area. How much down would that be then? About 100?
So 20% is $160,000.
Got you. So then if I decided to pull out, okay, let's just round it up to $200,000 out of my home. My rate today is 3.75. My payment's $2,000 a month. What's my payment difference there?
So, you're looking at a payment, it's going to go to about $3,400 a month, principal and interest. And if they had, 3.25 at $400,000, there's $1,700.
So they went from $1,700 to
26.
To 26. So they went about $900 a month to pull out that 200K. So I find a property for 800 grand. I put 160 grand down. And what are my new payments on that?
It's 3,600 is the payment. With tax and insurance, you're about 4,500 a month.
I'm about 4,500 a month. And so I'm putting about $250 a month positive cash flow in my pocket on average, right?
Correct. And the big thing remembering in investment properties, because a lot of people will look at how much they're cash flowing each month. What you also have to factor in is the equity growth that you're getting. you basically may be making $200 a month, $250 a month positive, but that person is paying down your mortgage for you, that renter.
Right.
So now you're at some point, let's say it's a 30-year loan. In 30 years, there's no mortgage. Those renters paid off your mortgage for you, and you've built equity. So it's really a twofold approach,
right,
that you're collecting both rents and growth, equity appreciation in your property.
Right. So essentially, it cost me $160,000 to invest, and in 30 years, I just turned that into $800,000 because now I own that property free and clear, and it should still be worth somewhat close to what I paid for it.
Yeah, I mean, and that's a very conservative, because if you just take cost of living and normal appreciation, in 30 years, it's going to be worth more, right, normally. But if you look at it, like you said, yeah, you basically just got an $800,000 house. You invested 160 into it, plus the extra rents that you've made. And obviously with rents going up in time, you're probably going to be collecting more in rent down the road as well.
So I took $300,000 or $400,000 and turned it into $800,000. Still not a bad investment. And you're taking this money that's trapped in your house, and you're actually able to do something with it right now. Yeah.
And all the greatest wealth in the world has always been evolving around real estate.
Right.
I mean, they might have invested or bought oil, but then they bought real estate with that money.
Right. Yeah. So now let's step back into the equity line, the HELOC. Now I don't have to touch my 3.5% rate. I don't have to worry about that. I still have my $1,700 payment on that money, but now I still need to pull out $200,000 on a HELOC.
Yep. So most lenders that offer the HELOCs, they'll go up to a 80% combined loan to value.
Okay.
So what they'll do is they'll take, for instance, whatever the loan balance is on your first. So if it's $400,000 in the same example, it's a $400,000 first, and then a $200,000 second. Divide that into the property value.
Okay.
So depending on what that property value is, so if they're looking at combined loans of $600,000 at, 80%, the property has to appraise for at least $750,000.
Gotcha.
And at $750,000, you could then potentially access up to $200,000 on a HELOC, a second mortgage. So how these HELOCs work, you'll hear terms HELOC, which stands for Home Equity Line of Credit.
Right.
So you'll hear that. You'll hear terms of lines of credit. All of that second mortgage are interchangeable. It's the same thing. And the way that they calculate these, they're kind of a teaser rate. So there's a low introductory rate, like sometimes you might get on a credit card. Hey, the first 6 months it's 0%.
Right.
Well, on these, they might be doing teaser rates right now at around 4% and interest only. So, hey, it's only 4% on the $200,000 for the first 6 months.
Wow. Then 200,000 times 4%, that's 8,000 a year, or about $600 a month.
Correct.
Okay.
So it sounds really good. I mean, when you look at the other way, we were going, well, that was $1,700 to access $200,000. This is only $600. But remember, it's a teaser rate. So that's what it's going to start with. So what usually will happen is it'll convert into a 20-year loan. So if you take a $200,000 loan amount, at a rate of, you can go at 7 for 20 years, that payment's now $1,550.
Gotcha.
On a $200,000 at 7%. So keep in mind again, it's still adjustable. So it may be at 7%, but it potentially could go to 9% or 10%.
Gotcha.
It's not stopping. It's tied to prime. So wherever that rate goes, it fluctuates. The other thing you got to remember is it works very much like a credit card. Think of them giving you a checkbook or a credit card when you get this line of credit, and you may not access the money. You may say, okay, I took a line of credit, but I didn't draw on the money. I didn't take any of that money out of that account. When you want to use it, you write yourself a check or pay somebody a check, and it comes out of that account, and you start paying on the balance you use. So as you're going, if you need 50,000, you write a check for 50,000, you're paying only on that amount that's being used, which is very nice because then you can control how much you're paying and it's not right away.
So I guess really it's going to be player's choice when it boils down to how does the investor want to do that? Does he want to take the risk of taking this equity line of credit and risk that the rates are going to go up and that he may end up with a 10% loan on there? Or does he want to play it safe, lock in a 5.5% interest rate and know that that money's there to tap into? And I mean, even if he didn't buy real estate, like you said, he sat on it for a little while till maybe even the market cooled down. Maybe he doesn't buy $800,000 price. Maybe he lets the market shift down and he picks something up for $600,000. He could still dump that money in some type of investment property to start earning money on it as well.
Absolutely. And keep in mind, there are different qualification guidelines on a line of credit. Because it is truly a second mortgage, it's a little bit more risky. A second mortgage, if somebody, the theory is if somebody stopped making their payments on a second mortgage, in order for that second mortgage to collect, they would have to pay off the first mortgage to collect on the second, because the first mortgage has priority on the property. The second lien holder couldn't just foreclose to get their money back. They'd have to pay off the first. So it's a little bit more risky of a position. So with that, underwriting guidelines are a little bit more stringent. It may be more like 2 years tax returns and certain credit scores minimum needed versus a first mortgage, maybe like we don't even need tax returns. I never want to give out tax advice. That's not my area of expertise.
Yeah.
But yeah, there are a lot of tax benefits, especially with the rental properties, of the expenses that you have, the property taxes, insurance, and maintenance, and all those things are deductibles. On the mortgages, because it's tied to a primary residence that you're taking cash out, that would be something you'd probably want to get tax advice on from your tax planner.
Any difference between if I bought a house or a condo? Does it any rate hits on anything like that? Where the equity line I guess the loan that we would use to buy the investment property, would there be any hits on the interest rates for buying a condo?
If you put less than 25% down on a condo, there's a little bit pricing adjustment where rates will be on average about 0.25% higher.
Okay.
For condos over a 75% loan to value.
So if I was thinking about buying a investment property that might be a nice townhome somewhere, I would probably want to put 25% down. Let's role play that out real quick. So I found something for 462. You're saying now I'm going to put 25% down, right, at 462. Yep. So now I'm putting 25% up. So I'm putting 115 grand down.
Yeah.
And let's say another 10 grand for closing costs. So that's 125. So let's say I pulled out 150,000 and not 200 grand, right, for something like that. And so now I bought this condo for 462. I put 115 down. What would my payments be on something like that, Mike?
Yep. So payment, the principal and interest is about $2,400. When you figure in taxes, insurance, and let's throw in $400 a month for some homeowners association dues.
Okay.
Your total expense on that townhouse with 25% down it's $2,900. $2,900.
Okay. And the rents that I pulled up for right now for that property would be about $2,800.
So it's pretty close to being a wash, about $100 difference.
Got you.
And then obviously, as we talked about, depreciation and stuff would balance that out.
Gotcha. And then I wouldn't be pulling out 200 grand. I'd be pulling out about 150. So that $1,700 bump would probably cut down to maybe $1,200 bump in my payment.
Correct.
Another 50 grand. Okay. Yep. Good. Any other thoughts that you have about investing right now, Mike? Or, if someone's out here and they're watching this video and they're like, man, I got this equity. Should I, shouldn't I? What would be some advice you would give them?
I mean, first and foremost, if you need to pull equity out of the house and you're not certain, now is the time to definitely be pulling and accessing your equity because your home value is the highest it's been. So that's the first starting point, because that's going to take about 30 days to get a loan done, to get that cash in hand to be able to start putting offers in. But as far as, is it a good time? Yeah, I mean, I think so. When we look at numbers like this that are penciling out, where rents are pretty close to what your mortgage payment is,
Yeah,
and then adding in the appreciation of them paying down your mortgage and paying off that loan for you over 30 years. Yeah, that makes sense. The big thing now we're hearing is, people adding on to their properties, separate structures and things like that. And even these separate structures, people are renting for a couple $1,000s a month for 1,000 square foot little, guest house, basically, for lack of better words.
Yeah. Well, Mike, thank you very much for your time. I really appreciate that. I know our viewers got some good information out there. If anybody was interested in doing a refi with you, Mike, how would they get a hold of you?
Best way is my website you can go to, which is our company name, if you can see on my shirt.
And Mike, like you, we are both a father and son team. My son Matthew works with me. Your son Ben works with you. So, everybody out there, Mike and I, we've got a long generation of realtors and finance people to continue on our legacy of being in this business. So that's awesome.
Yeah, we're not going anywhere anytime soon.
Yeah, love it, Mike. All right, good talking to you.
Likewise. Thank you for having me, Tom.
All right, bye, guys. All right, so that was my interview with Mike, where we talk about refinancing, cash out, buying a rental property, positive cash flow, the pros and the cons. I think the big takeaway out of this, it's really going to be the player's choice, whether you want to do a HELOC, home equity line of credit, to pull some of that money out, or would you rather pull out a cash out refi? So either one, I think, is going to be good. You just need to kind of make the determination which one would be better for you. Hey, if you like this video, make sure that you hit the subscribe button down below so that you can be notified of future episodes. And if you have any real estate needs for me or my team, we'd love to meet with you. There's a Calendly link where you can book a meet with us at any time, and feel free to get a hold of Mike. We'd love to help you guys in any way that we can. All right, guys, thanks, and we'll see you on the next video.